Good afternoon. Good afternoon, guys. This is Franco back here for the FOMC meeting. All right, a couple of things that I want to review before the rates news comes out. Right, we are expecting 75 basis point rate hike. And give me 1 second. Okay, cool. So we are expecting 75 basis point rate hike. So for that, let's go right into this is the YouTube for the Federal Reserve. So we will be live streaming this thing. But before we start, right? There's one report. There's the one that I'm more interested in this afternoon, and is the SEP, the Summary of Economic Projection. And here is the last one. This report comes just 4 times a year, and the Fed meets. They meet 8 times a year. But this report just comes out 4 times, right? The last one was in June 15th. So there are a couple of things that I want to pay attention to this in this report. And these are all the numbers. Let's zoom in, right? For the most important indicators that they watch, right? So they have the GDP, right? So they lowered this number. If you see here, in March they were expecting 2.8, and in June they brought it down to 1.7. Okay. Unemployment rate, PCE. PCE is the inflation measure. The inflation measure that they use. So PCE is personal consumer spending. PCE. Personal consumption expenditures, right? So that's what they use. They don't use the CPI. And the core PCE, right? Then the funds rate, and what I'll be, paying attention to is the range here from 3.1 to 3.9, right? So there are a couple of things that I want to be aware before the report comes out, and are 2 things, right? I will give some negative connotation if the change in real GDP here is a 0 in the front number. Instead of 1.7, it is 1.3, 1.4. I do expect this number to come down, but I do not expect to watch a 0 in the range. Okay. If I have 0 point something here, that will be very, very bad news. Okay, because they are actually accounting for a deceleration in the economy that is not priced in right now. Okay. Employment rate, my expectations is that this number is gonna go a little bit higher. I would say like probably 4.5% on the higher part of the range, right? And the federal funds rate, this is the other one that I'm paying attention. Like here, I don't want to see here more than 4.5. If I see more than 4.5 here, it'll be catastrophic for markets. Okay, so if our goal this year is 3.9 or less, I think it'll be good news, and the market can rally from them. We're certainly going up right now on the expectation that probably we will have some sort of better news than expected. Now I've said this. I went to the chart for the dollar for the last 4 meetings, and the dollar, what it does is that it drops. With the Jerome Powell's statement with the federal fund rates, the last 4 meetings, the dollar has dropped in every meeting. We haven't had any dollar strength right after the news is out. Right when the news breaks, the dollar always collapses. For the following days has recovered, obviously, because the dollar is just going up. But I'm just pointing out that that happens in every meeting. Well, the last 4 meetings. Okay. So with that, we're barely 2 minutes from the results. Probably the spread is already high. Actually, I want to go check the euro dollar. Let's go check the euro dollar. Rates are going up also. The yields, sorry, the bond yields. Euro USD, and the spread is I cannot see the spread right here, but it should be already wide. So we are 1.5 minutes, and what I'm going to do, I'm going to go to the Federal Reserve here. This is the website. Oh, let's watch this, because let's refresh 1 minute from the news. Let's refresh this page. So the 75 basis point rate hike is 84% probable and 16% probable for 1%. I will go with the 75. I think that Jerome Powell personally doesn't like to shock the markets, so I would expect 75. So let's put a little bit of the news to see if no, this thing is probably not. All right, this page collapsed. It's not loading. All right, this thing should be out, and the market rallied a little bit. It spiked. The dollar is not moving though. Wow, what is this? Wow, it's dropping big time. All right, let's see if we can load this chart. Let's see if we can load this chart. All right, my computer collapsed. This website is not. Okay, there you go. FOMC. Modest gain. Rate 2%. Inappropriate. Okay. So right here, 75 basis point. That's rate hike, 75 basis point. So that's the expectations. 0.75%. So let's go here to the economic projections report. Summary of economic projection. Oh my God. Oh my God, that is what I was referring to. Look at this. Oh my God, this is gonna be ugly, guys. This is not going to be good. That's why the markets are giving up all these its gains. I I was saying real GDP. I don't want anything with a zero in front. Look at this. Oh my God. So this is not good. All right, let's keep going. PCE inflation actually is not bad. This number came down big time. And actually here I said not more than 4.5. So we might have more rate hikes for the rest of the year. We might have more rate hikes for the rest of the years. The market is pricing in one more 0.25% rate hike in November, and then in December 0.25%. But no, they're estimating more. So let's go to the dot. Let's go to the dot chart. For those who don't know how to read this chart, so every dot means one of the governors of the Federal Reserve. So look how many governors are agreeing that 4.5 should be the rate by the end of the year. 4.25, 4.5. So just one on each extreme, but all of them above 4%. So we will actually have 4% this year. I don't think that is priced in into the markets. And this shocked me, to tell you the truth. This thing here shocked me big time. I didn't expect this. I was probably expecting 0.7 to 1.2, but they are expecting a deceleration on the economy big time. Let's go hear what they say.
Just a bit, of course, waiting for Q&A. Ultimately, another dynamic was prevalent right before the announcement. 30-year and 10-year yields were on top of each other. It actually inverted briefly. That's a very unusual inversion, because 30s to 10s, known as the knob spread, since 2006 has only had 2 sessions, and they were both this year, where they closed inverted. You want to pay attention there. And last but certainly not least, the dollar index, certainly the beneficiary of the path the Fed has.
Yeah, the dollar has.
Let's check in now with Bob Pisani. We had
look at that.
There a 200-point swing from where the Dow was.
Oh my God.
Right on the precipice of the announcement to where we are now, which is down 168. We were up about 160. Now we're down 160. That's what, 320 points actually.
Yeah, MB.
Yeah, and
I'm trying to do my best
we were
here.
At 3880 or so, and we've dropped about
Let me lower the volume. I got
or so since then. And
do you guys hear the news?
This is what the market didn't want, the higher for longer scenario.
So while Powell comes out, we can watch the news and talk about the interpretation of this report.
2023, no reductions until 2024. That quite priced into the market, so very understandably why.
The summary of economic projection is dollar is skyrocketing. Ooh, almighty dollar. This is gonna be not good. I do have some expectations, and the dollar is pricing in some sort of crisis that the market, I don't think the market is accounting for. The dollar is moving too fast. And guess what, guy? Guess what? And we have talked about this, and I've talked about this chart. This is the chart that now is telling me things are not going to be fun. The VIX chart. Finally, investors are reacting to these sort of news. Look what the VIX is doing. It's breaking up 11%, right? 11%. Look, the rate hike was expected, but the projection on the economy, not good. Projections on the economy are not good at all.
That they're aware, at least, of the slowdown. And remember, Powell is winning on a lot of fronts here.
Yeah, there's this stupidity that is happening in the real estate market. Actually, I want to buy right now, but prices are too high. Affordability is is at all-time highs. But people are running into deals thinking that the rates might be going to 10%. I don't think it's possible, but that's what is happening right now.
Discussion with our panelists, and David, I want to go with you. The Fed reiterating that
yeah, people are trying to buy right now because they think rates can keep going up. Now look at the VIX; it changed. So let's go see the lower time frame. Oh, it gapped down right here. It doesn't make sense. Let's wait for it to settle down a little
trying
bit.
to figure out what I'm supposed to be so scared about here. If you look at their projections, they think that inflation will come steadily down. Now, it might take a little while to get to 2%, but honestly, has anybody's life changed between 2 and 3%? I get it that 9% inflation is absolutely intolerable, but those days, I think, are already behind us. And meanwhile, what I think is really interesting in this is if you look at the dot plot, they've built in
I don't know if 35% that's very rush. Like
50 in December,
it's very hard 35%, but I think 20% is not unrealistic. And
I just don't think the
I have very little experience. I've been trading for 5 years, and I would say like seriously more like 3 years.
Home buyers have been knocked out of the market by 6% mortgage rates. You've got fiscal drag going on.
And seeing the markets going down this way is very hard.
It really looks like it could get pushed into recession.
So NQ is minus 0.70%. We were up probably close to 1% or more than 1%.
And that metaphor is certainly a frightening one. Certainly, what Bob said, Ms. Nixon, is that
yeah. So let's quiet these guys a little bit. Yeah. So let's go back to the let's quiet these guys. Let's quiet these guys while we go over this report again slowly. It says looking puts Beto. Yeah. Wow. How much is $0 though? I was watching it, but I lost track. I lost track of it. .983. 0.983. Oh my god. Wow. Prices of homes will go down exponentially. That's the correction I am speaking about. Oh yeah. 35% in real estate, I think it's doable. I think it might happen because they just went up 20% last year, only last year. So 35% is not unrealistic. All right, so but let's go over this report again. I want to just more with more detail see what happens here. Like I said at the beginning of the video, the zero at the front number was going to be very bad, and we have the median 0.2. Oh my god, we might be in negative numbers. I don't think they're willing to. Oh, look at this. Oh my god, look at 2023. They're actually accounting for a negative low end, negative 0.3%, and now a recover for 2024 and 2025. But I don't trust these numbers too much. I think to predict macroeconomic events are so hard. Like a monkey can do it better. Like I don't. I mean, I'm not gonna undermine these guys. They are very educated people, but I think a monkey can make a better prediction than an economist. That's my perception. All right. So unemployment rate. They are actually thinking that the labor market is very strong because they haven't moved this number on the high end. So 4.0% unemployment and probably up to 5% on 2023 with a negative number here. I don't think this is realistic. they do think actually that the labor market is stronger than, I don't know. All right, what about inflation? I said 6.5 here on the high end, but actually is better, but still quite high. So if they expect the PCE to come down from like 2.4 to 4.1 on the next year, I think probably the CPI will be around 6 or 7%. Still high. Is very far from, and look at that, they're projecting 2 and 3% in for 2025, between 2 and 2.5. If the federal funds rate, they're gonna stay high. I think they're gonna stay high. Let's go back to the dot chart. Dot chart is is the best gauge that you can use, because you see how governors are voting right now. So all these governors are voting for 425. That means we will have probably 2 more 50 basis point this year. At least 2. And then we could have 1.75 and 150, because the majority is actually here. All right, so let's see. Yeah, we're not in a recession. Yes, we are. Yes, we are, and this number tells you. I don't think they're willing to put a negative here as of yet, until inflation comes down. But once inflation start to go down, they will be open to put a negative number right here. I understand they don't want to shock the markets, but for me, it's pretty shocking. This report is pretty shocking. That's not good. All right, let's go back here and see what these guys are saying. Oh, this guy, I like this guy actually.
To the central bankers who really caused this mess, because they caused us to be in a place where the solution had to be this painful.
David, a stronger dollar, higher rates, how does this change the calculus for stocks? We've certainly seen earnings estimates come down in recent weeks.
Well, yes, it's going to be a tough year ahead for earnings, no doubt about it. But in a way, one of the reasons I don't like the Fed being too aggressive right now is that I want them to actually be able to get to positive real rates and stay there. What I think they're setting up is a situation where they actually put the economy in recession, and then, much as they would deny it today, they are eventually going to reverse course.
So we will look for trades right after the press conference. I don't want to get into this mess right now. When Powell comes out, this thing is going to move too hard. It's going to blow a bunch of zones. It's going to be more like trying to get lucky than real trading. So for me, is I'll wait at least till Powell just go out of the podium, and then I can look for good areas to trade from.
Real hawkish report here for sure on the part of the Fed, and I think investors.
I haven't traded today. Like, I did have that long, but I didn't take it, and then that's it. I was trying to fix my computer today. It's acting very weird.
Steve what he's going to ask the chairman, but I'm going to let that be our big surprise. Panelists, thank you very much. We appreciate your time today. As always, all of you, thank you for joining us. Coming up, former Fed Governor Frederick Mishkin will tell us whether he thinks the central bank is on the right track. Finally, we're making a policy mistake.
All right. So we're waiting for Powell to come out. 15 minutes. I'm paying attention to your comments, guys. What do you guys think about this? This is not bueno. This is not bueno. Let's see if I have Bloomberg here. All right, so let's go here. Let's go here. All right. See if I can put Bloomberg.
Were not accurately reflecting the reality of what would have to happen in order to bring down inflation. Diane Swank joining us now, chief economist at KPMG. We did see a revision in some of the unemployment.
I cannot reproduce this, so
how long they'd have to hold rates
let's put it here.
Do you think that this is going into the realm of reality?
It's still not quite there, and I think Rich is exactly right on that. I think the key issue to really lock onto in this is something, a point that Rich made, that core inflation is looking sticky. The Fed had confirmation bias with the CPI that came out confirming its worst fears, and that is inflation is more inertial. This is something we're also seeing in surveys of businesses versus surveys of consumers. Our own internal surveys, which we hope to publish soon, are showing that businesses have much higher inflation forecasts and unit labor cost forecasts than consumers. And that's important both 1 year and 5 year out, because they have decisions over both wages and prices. And that's something that the ECB is looking at as well, as a sign that we may be seeing some unmooring of inflation expectations. And I would be interested to hear in what Rich says the unemployment rate has to be. Our own analysis is with these kinds of numbers, we're going to see an unemployment rate that goes above 5%.
Yeah, this lady that is talking makes a lot of sense here. She's talking about unemployment being more than 5%.
With the recession now, and I think that's the way you have to look at this. They're talking about sub-potential growth in both 2022 and 2023.
Yeah, depending on when you're retiring. If you're retiring in 10 years, I would say more like 5 years. I would give it. Like if you're retiring in 15 years, there is no problem. But I think the next 5 years are going to be tough.
And then an additional 25 basis points next year. That is a lot of rate hikes, and I think we're going to see some nonlinearity to that. I do think that the strong dollar is more a problem abroad, but we don't know what kinds of sins.
Oh, you already retired? Damn. How old are you, MB?
I worry about what are we going to see revealed as rates go up higher and in a a more dramatic fashion. It's nonlinear.
Rich, you got the floor.
I would simply, hi Diane.
Oh,
I would simply say that if you go
nice, 59. I'm very humble though. I'm 39. Thanks for watching me.
Which I was around for, although 3 years old, the unemployment rate goes up by 1.5%. So even in a mild recession, a rise in the unemployment rate of less than a point would be actually quite unusual. So if you think it's going to take some form of recession to disinflate this economy, then I think probably yes, something closer to 1.5% rise in the unemployment rate is more consistent with that.
This is a delicate question, but John has mentioned this quite a bit. Hold
on. Well, it's not my opinion. We're watching here the September. We're watching here the it's not my opinion, but is what these guys are saying. These are the governors. So they're saying this year we could have up to 4.6%. And if you go here to the dotted chart, you can see how the majority are in favor of 4.25%. 4.25%. So right now is right now, let's put here federal funds rate probabilities. You go to the CME website. Is the CME website cmegroup.com. cmegroup.com. I don't know why my computer is so stubborn, because I have too many things uploaded here. Let me lower the resolution right here. All right, so the next meeting is 41 days out, right? So let's see the probabilities for next meeting, and let's wait for it to load while we wait for Jerome Powell. Jerome Powell is gonna come out at 2:30. Is 2:23. All right, let's wait for this chart to load. Is this website might be too crowded, like too many people watching this thing. Let's go for the alternative. That's investing.com, a federal funds rate probability, finance rate, no. Federal funds rate probabilities. Yeah, Fed rate monitor tool. If you go to the investing website, there you go. Oh wow. So they are predicting 75 basis points again. So the current rate is 3.25. I mean 3. They give you a range, right? From 3 to 3.70 3.25. That's the current one. And then the next one will be 75 basis points again. That's why the markets are dropping big time. This was not expected. They were saying, and if you see here, they were saying, all right, in June, by the end of the year, max, we're gonna have 3.9, no more than that, right? Well, that changed. Now 3.9 is the new floor, right? So 3.9 is a new floor. So if we go here, 3.9 is 0.75%. Now this might change, and we might have 50 basis point. But look at this in this chart. The sorry, let me move this chart a little bit. All right, there you go. So here you say 350, which is 50 basis points for next meeting, is 0% probable. 0% probable. Whereas the yesterday was 25%. Now is 0.75% or 1%. So the 0.75% is the higher probability, is 95%. Again, 0.75, yeah. If CPI comes below 8%, I'm gonna be honest, I don't think they care about CPI so much as they care about PCE. And I do think CPI has a lot of flaws embedded in the system, how they do. Now CPI, I don't think CPI will come down so easy, because like 20% or 25% of that index comes out of the housing market, right? How home prices. And how they measure rents is with the homeowner equivalent rent survey. So the way they do is they call homeowners, right? Let's say I own a house and they call me, and they ask me, hey, how much will you rent your house if you were renting, right? And I tell them X, whatever, $3,000. And that's how they survey homeowner equivalent rents. How the rent number comes to the CPI indicator. And now rents are going up because housing affordability is at all-time highs, right? You cannot buy. Housing affordability is at all-time low. Nobody can buy a house, and but buying a house is not a necessity. You can skip buying a house. You can actually, if you're moving to another city, you don't have to buy. That's not a necessity. Whereas if you're gonna leave, which everybody's gonna live somewhere, they need to rent. So that's a necessity. So rents. I don't think rents are gonna go down anytime soon. While housing affordability is so difficult for people, rents are gonna stay high unless we start to have cracks in the economy that actually start to break people down, like a lot of unemployment, etc. Right? But unemployment is the last economic indicator, is the most lagging economic indicator. So if we start to see unemployment rising, we might be getting out of the recession already. So first indicator that we have to see, believe it or not, is the housing market. That's the one that we have to pay attention to. Housing market. And volume of sales are coming down. Yeah, the way they measure the unemployment is also cooked. CPI is cooked. Everything is cooked. So we might have a lot of worse numbers that we're watching right now, but I think QT hasn't. We haven't. Oh, do you guys see me? Oh, this thing just froze. It's frozen. All right, now it's good. All right, so Jerome Powell is about to start, but okay, cool. Sorry about that. Like I have so many things going on with my computer today. I might have to reset it during the weekend. QT, we haven't felt QT yet. That takes a lot of time. I would say like from 6 months to 1.5 years. That's what expert says regarding that matter. So, but we haven't had like QT like this one. So this guy is coming out. Let's put the sound in. Let's put the sound. All right.
Good afternoon. My colleagues and I are strongly committed to bringing inflation back down to our 2% goal. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised its policy interest rate by 0.75 percentage point, and we anticipate that ongoing increases will be appropriate. We are moving our policy stance purposefully to a level that will be sufficiently restrictive to return inflation to 2%. In addition, we are continuing the process of significantly reducing the size of our balance sheet. I will have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed from the historically high growth rates of 2021, which reflected the reopening of the economy following the pandemic recession. Recent indicators point to modest growth of spending and production. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, in large part reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment, while weaker economic growth abroad is restraining exports. As shown in our summary of economic projections, since June, FOMC participants have marked down their projections for economic activity, with the median projection for real GDP growth standing at just 0.2% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. Despite the slowdown in growth, the labor market has remained extremely tight, with the unemployment rate near a 50-year low, job vacancies near historical highs, and wage growth elevated. Job gains have been robust, with employment rising by an average of 378,000 jobs per month over the last 3 months. The labor market continues to be out of balance, with demand for workers substantially exceeding the supply of available workers. The labor force participation rate showed a welcome uptick in August, but has little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing the upward pressure on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.4% at the end of next year, a half percentage point higher than in the June projections. Over the next 3 years, the median unemployment rate runs above the median estimate of its longer-run normal level. Inflation remains well above our 2% longer-run goal. Over the 12 months ending in July, total PCE prices rose 6.3%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In August, the 12-month change in the Consumer Price Index was 8.3%, and the change in the core CPI was 6.3%. Price pressures remain evident across a broad range of goods and services. Although gasoline prices have turned down in recent months, they remain well above year-earlier levels, in part reflecting Russia's war against Ukraine, which has boosted prices for energy and food and has created additional upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.4% this year and falls to 2.8% next year, 2.3% in 2024, and 2% in 2025. Participants continue to see risks to inflation as weighted to the upside.
So the dollar is coming
Despite
down
elevated
with this guy
inflation,
talking.
longer-term deflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.75 of a percentage point, bringing the target range to 3 to 3.25%. And we are continuing the process of significantly reducing the size of our balance sheet, which plays an important role in firming the stance of monetary policy. Over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the federal funds rate will be appropriate. The pace of those increases will continue to depend on the incoming data and the evolving outlook for the economy. With today's action, we have raised interest rates by 3 percentage points this year. At some point, as the stance of monetary policy tightens further, it will become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation.
So
we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible.
Pace of rate hikes.
Restoring price stability will likely require maintaining a restrictive policy stance for some time. The historical record cautions strongly against prematurely loosening
15
policy.
minutes, probably 10 minutes. Then they have
As shown
the
in the
press
SEP,
conference.
the median projection for the appropriate level of the federal funds rate is 4.4% at the end of this year, 1 percentage point higher than projected in June. The median projection rises to 4.6% at the end of next year and declines to 2.9% by the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. We are taking forceful and rapid steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth, and there will very likely be some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. We will keep at it until we're confident the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
All right, let's wait for the questions. Let's see how this guy responds.
Hi, Chair Powell. Thank you for taking our questions. Gina Smiley from the New York Times. I wonder if you could give us a little detail around how you'll know when to slow down these rate increases and how you'll eventually know when to stop.
So I will answer your question directly, but I want to start here today by saying that my main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%, and we will keep at it until the job is done. So the way we're thinking about this is the overarching focus of the committee is getting inflation back down to 2%. To accomplish that, we think we'll need to do two things in particular to achieve a period of growth below trend and also some softening in labor market conditions to foster a better balance between demand and supply in the labor market. So on the first, committee's forecasts and those of most outside forecasters do show growth running below its longer run potential this year and next year. On the second, though, so far there's only modest evidence that the labor market is cooling off. Job openings are down a bit. As you know, quits are off their all-time highs. There's some signs that some wage measures may be flattening out but not moving up. Payroll gains have moderated, but not much. And in light of the high inflation we're seeing, we think we'll need to, and in light of what I just said, we think that we'll need to bring our funds rate to a restrictive level and to keep it there for some time. So what will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down.
Yes, that's what he's looking for. Layoffs.
So that's what we'll be looking for.
There you go.
In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
Steve.
Thank you, Mr. Chairman. Steve Leisman, CNBC. Can you talk about how you factor in the variable lags on inflation and the extent to which the outlook for rates should be seen as linear in the sense that you keep raising rates, or can you envision a time when there's a pause to kind of look at what has been wrought in the economy from the rate increases? Thank you.
What is that question?
Sure. So, of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. But it's likely to take some time. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation. So that's how we think about that. Your second question, sorry, was?
Is there a point in time that you can see pausing? Is it linear that you keep raising rates, or is there? Oh, I'm sorry. I should know better than to not talk with the microphone.
I should know better than to answer your second question.
Oh, there you go. Is it linear? Do you keep raising rates, or is there a pause that you could envision where you kind of figure out what
the
has happened to the economy
cracks,
and give time to
they
catch
won't
up
pass.
in the real economy?
They won't
rate increase time to catch up in
pause.
the real economy. Thank you.
So I think it's very hard to say with precise certainty the way this is going to unfold.
Employment is what they're looking for.
What we think we need to do and should do is to move our policy rate to a restrictive level that's restrictive enough to bring inflation down to 2%, where we have confidence of that. And what you see in the SEP numbers is people's views as of today, as of this meeting, as to the kind of levels that will be appropriate. Now those will evolve over time, and I think we'll just have to see how that goes. There is a possibility certainly that we would go to a certain level that we're confident in and stay there for a time. But we're not at that level. Clearly today we've just moved, I think, probably into the very lowest level of what might be restrictive, and certainly in my view and in the view of the committee, there's a ways to go.
Rachel.
All right, the dollar keeps going down.
Rachel Siegel from The Washington Post. Thank you for taking our questions. The projections show the unemployment rate rising to 4.4% next year. And historically, that kind of rise in the unemployment rate would typically bring a recession with it. Should we interpret that to mean no soft landing? And is that kind of rise necessary to get inflation down?
There's no soft landing.
Right. So
no soft
you're right.
landing,
in the SEP, there's what I would characterize as a relatively modest increase in the unemployment rate from a historical perspective, given the expected decline in inflation. Now, why is that? So really, that is what we generally expect, because we see the current situation as outside of historical experience in a number of ways, and I'll mention a couple of those. First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer run inflation expectations have generally been fairly well anchored. As I've said, there's no basis for complacency there, but to the extent that continues to be the case, that should make it easier to restore price stability. And I guess the third thing I would point to that's different this time is that part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy, and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles.
So the market is
and in
going
principle,
up.
if those things start to get better, and we do see some evidence of the beginnings of that. It's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation. So let me just say how much these factors will turn out to really matter in this sequence of events. It remains to be seen. We have always understood that restoring price stability while achieving a relatively modest decline, a rather increase in unemployment, and a soft landing would be very challenging. And we don't know. No one knows whether this process will lead to a recession, or if so, how significant that recession would be.
We're already
That's
in a
going to
recession.
depend on how quickly wage and price inflation pressures come down, whether expectations remain anchored, and whether, also do we get more labor supply, which would help as well.
Yeah, there were.
In addition, the chances of a soft landing are
Oil
likely to diminish to the extent that
$90
policy needs to be more restrictive
Ukraine,
or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
Just to follow up on one small thing, are vacancies still at the top of your list in terms of understanding the labor market and how much room there is there?
Yes, vacancies are still almost 2-to-1 ratio to unemployed people. That and quits are really very good ways to look at how tight the labor market is and how different it is from other cycles, where generally the unemployment rate itself is the single best indicator. We think those things have for quite a time now really added value in terms of understanding where the labor market is.
Yeah, sure. Not true.
Nick Timmeros of the Wall Street Journal. You said not too long ago in describing the policy destination, there's still a way to go. But I imagine you have to have some idea about how you're thinking about your destination, whether it's a stopping point or a pausing point. And so I was wondering if you could discuss how you are thinking about, as the data come in, where that destination is, how it's moving up if inflation doesn't perform as you expect. Do you want to have a policy rate that's above the underlying inflation rate, for example? And do you have an estimate for where you think the underlying inflation rate might be in the economy right now?
Well, so again, we believe that we need to raise our policy stance overall to a level that is restrictive. And by that I mean is meaningfully putting meaningful downward pressure on inflation. That's what we need to see in the stance of policy. We also know that there are long and variable lags, particularly as they relate to inflation. So it's a challenging assessment. So what do you look at? You look at broader financial conditions, as you know. You look at where rates are, real and nominal in some cases. You look at credit spreads. You look at financial conditions indexes.
Inflation expectations.
I think, and you see this this is something we talked about today in the meeting and talk about in all of our meetings, and you see this, I think, in the committee forecast. You want to be at a place where real rates are positive across the entire yield curve. And I think that would be the case if you look at the numbers that we're writing down and think about you measure those against some sort of forward-looking assessment of inflation expectations. I think you would see at that time, you'd see positive real rates across the yield curve, and that is also an important consideration.
We have never lowered inflation if rates don't go higher than inflation expectations.
Hi,
so that's the
Howard
key
Schneider
number.
with Reuters. Thanks for the opportunity. I just want to be clear on the steps. You say it's meeting by meeting, but it sure looks like we're going 75, 50, 25. Is 75 next month the baseline?
So we make one decision per meeting, and
less oil.
The decision we made today was to raise the federal funds rate by
now
75.
With Trump, it's not because I want to get
you're
political,
right
but with Trump we were energy sufficient.
The median
for we didn't have
year-end
to
suggests another 125 basis points in rate increases.
Oil. Now we have to buy oil.
There's another fairly large group that saw 100 basis points addition to where we are today. So that would be 25 basis points less. So we're going to make that decision at the meeting. We didn't make that decision today. We didn't vote on that. I would say that we're committed to getting to a restrictive level of for the federal funds rate and getting there pretty quickly, and that's what we're thinking about.
So just as a follow-up to that, I'm wondering about the sort of risk management considerations here. Given there's some discussion now of overdoing it, what's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
Let's go to Colby.
Thank you. Colby Smith with the Financial Times. Chair Powell, how should we interpret the fact that core inflation is still not forecast in the SEP to be back to target in 2025, and yet the dot plot projects cuts as early as 2024? And does that mean there's a level of inflation above the 2% target that the Fed is willing to tolerate?
So I guess core is at 2.1 in 2025, and in the median, and headline is at 2.0. So that's pretty close. I mean, we write down our forecasts and we figure out what the median is and we publish it. So it's not. I mean, I would say that if the economy followed this path, this would be a pretty good outcome. But you're right, it is a tenth higher than 2%.
Okay, just as a quick follow-up, I mean, if the concern is that underlying inflation is becoming more entrenched perhaps each month, then why forego the more aggressive 100 basis point increase today? And does that risk having to do more later on?
Yeah, so we, as we said, at the last press conference and in between that one and this one, we said that we would make our decision based on the overall data coming in. So if you remember, we got a surprisingly low reading in July, and then a surprisingly high reading for August. So I think you never want to overreact too much to any one data point. So if you look at them together, and as I just mentioned, if you really look at this year's inflation, 3, 6, and 12-month trailing, you see inflation is running too high. It's running 4.5% or above. You don't need to know much more than that. If that's the one thing you know that this committee is committed to getting to a meaningfully restrictive stance of policy and staying there until we feel confident that inflation is coming down. So that's how we think about it.
1%, not much.
Hi, Victoria Guida with Politico. I wanted to ask about the balance sheet. You all have left open the possibility that you might sell mortgage-backed securities, but we've seen significant slowing in the housing market. Mortgage rates have gone up significantly, and I'm just wondering whether conditions there might affect your plans for how quickly you have the runoff on the MBS side.
So what we said, as you know, was that we would consider that once balance sheet runoff is well underway. I would say it's not something we're considering right now, and not something I expect to be considering.
I don't think they would be able to sell all the MBS that they have.
It's something I think we will turn to, but the time for turning to it has not come and is not close.
Well, and will conditions in the housing market affect that decision?
I think a number of things might affect that decision, but the main thing is we're not considering that decision, and I don't expect that we will anytime soon.
Thank you. Neil.
Thanks. Neil Irwin with Axios. A number of commentators have come to the view, and including over at the World Bank, that simultaneous global tightening around the world creates a risk of a global recession that's worse than is necessary to bring inflation down. How do you see that risk? How do you think of coordination
between
central bankers?
That's the entire amount. I think MBS is probably like 30 or 40% of that amount.
So we actually, my colleagues and I, a number of my FOMC colleagues and I just got back from one of our frequent trips to Basel, Switzerland, to meet with other senior central bank officials from around the world. We are in pretty regular contact, and we exchange. Of course, we all serve a domestic mandate, domestic objectives.
I want to be sure of that number. I'm not sure.
Price stability. But we regularly discuss.
They want to sell $1 trillion
what we're seeing in terms of our own economy and international spillovers, and it's a very ongoing, constant
so that
kind of a
includes
process.
MBS. Sorry.
we are very aware
MBS.
of what's going on in other economies around the world and what that means for us and vice versa. The forecast that we put together, that our staff puts together and that we put together on our own, always try to take all of that into account. I mean, I can't say that we do it perfectly, but it's not as if we don't think about, the policy decisions, monetary policy and otherwise, the economic developments that are taking place in major economies that can have an effect on the U.S. economy. That is very much baked into our own forecast and our own understanding of the U.S. economy as best we can. It won't be perfect. So, I don't see it's hard to talk about collaboration in a world where people have very different levels of interest rates. If you remember,
I'll be trading after the news, but when he is out of the podium.
Really, we're in very different situations. But I will tell you that our contact is more or less ongoing.
Be blown so easily.
And it's not coordination, but there's a lot of information sharing, and we all, I think, are informed by what other important economies and economies that are important to the United States are doing.
I'll stay here.
Craig.
I'll see if I have any setup. I'll trade.
Craig Torres from Bloomberg. Chair Powell, you talked about some ways the higher interest rates are affecting the economy, but we've also seen a resilient labor market with durable consumption, strong corporate profits. And I'm wondering what your story is on the resilience of the economy. After all, you and your colleagues said, well, we started tightening in March when we were talking about interest rates in the future. And indeed, Treasury rates moved up. So we should have had a lot of tightening taking effect. Why is the economy, in your view, so resilient, and does it mean that we might need a possibly higher terminal rate?
You're right, of course. The labor market in particular has been very strong, but there are the sectors of the economy that are most interest rate sensitive are certainly showing the effects of our tightening, and of course the obvious example is housing, where you see declining activity and of all different kinds, and housing price increases moving down. So we're having an effect on interest-sensitive spending. I think through exchange rates, we're having an effect on exports and imports. I think so. All of that's happening. But you're right. And we've said this. This is a strong, robust economy. People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there, although not as much at the lower end of the income spectrum, but still some savings out there to support growth. The states are very flush with cash, so there's good reason to think that this will continue to be a reasonably strong economy. Now the data sort of are showing that growth is going to be below trend this year. We think of trend as being about 1.8% or in that range. We're forecasting growth well below that, and most forecasters are. But you're right. There's certainly a possibility that growth can be stronger than that, and that's a good thing because that means the economy will be more resistant to a significant downturn. But of course we are focused on the thing I started with, which is getting inflation back down to 2%. We can't fail to do that. If we were to fail to do that, that would be the thing that would be most painful for the people that we serve. So for now, that has to be our overarching focus. And you see that, I think, in the SEP, in the levels of rates that we'll be moving to reasonably quickly, assuming things turn out roughly in line with the SEP. So that's how we think about it.
Mike, thank you.
Thank you, Mr. Chairman. In a world of euphemisms that we live in here with below-trend growth and a modest increase in unemployment, I'm wondering if I could ask you a couple of direct questions for the American people. Do the odds now favor, given where you are and where you're going with interest rates, favor a recession? 4.4% unemployment is about 1.3 million jobs. Is that acceptable job loss? And then given that the data you look at is backward-looking and the lags in your policy are forward-looking and you don't know what they are, how will you know, or will you know, if you've gone too far?
So I don't know what the odds are. I think that there's a very high likelihood that we'll have a period of what I've mentioned is below trend growth, by which I mean much lower growth, and we're seeing that now. So the median forecast, I think, this year for among my colleagues and me was 0.2% growth. So that's very slow growth, and then below trend next year. I think the median was 1.2, also well below. So that's a slower. That's a very slow level of growth, and it could give rise to increases in unemployment. But I think that is something that we think we need to have, and we think we need to have softer labor market conditions as well. We're never going to say that there are too many people working, but the real point is this. Inflation, what we hear from people when we meet with them is that they really are suffering from inflation. And if we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. Oof. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation, and that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
Well, how will you know, or will you know, if you've gone too far?
It's hard to hypothetically deal with that question. I mean, our really tight focus now continues to be ongoing rate increases to get the policy rate up where it needs to be. And as I said, you can look at this SEP as today's estimate of where we think those rates would be. Of course, they will evolve over time.
Chris Rugaber.
Thanks. Chris Rugaber, Associated Press. I wanted to follow up with what you just mentioned about the labor market. You've said several times that to have the labor market we want, we need price stability. And you've suggested maybe there isn't a trade-off in the long run. But in the short run, there is a lot of concern, as people have been expressing here, about higher unemployment as a result of these
holding
rate
that level, 110.8, 110.78.
So can you explain, though, what about high inflation now?
See if we can get to
threatens the job
111.1. That can be a good long 111.1.
High inflation will eventually lead to a weaker job market. So can you spell that out a little more for the general public and how that would work?
So for starters, people are seeing their wage increases, their wage increases eaten up by inflation. So if your family is one where you spend most of your paycheck, every paycheck cycle, on gas, food, transportation, clothing, basics of life, and prices go up the way they've been going up, you're in trouble right away. You don't have a cushion, and this is very painful for people at the lower end of the income and wealth spectrum. So that's what we're hearing from people is, it very much that inflation is really hurting. So how do we get rid of inflation? And as I mentioned, it would be nice if there were, a way to just wish it away, but there isn't. We have to get supply and demand back into alignment, and the way we do that is by slowing the economy. Hopefully, we do that by slowing the economy, and we see some softening in labor market conditions, and we see a big contribution from supply side, improvements and things like that. But none of that is guaranteed. In any case, our job is to deliver price stability, and I think you can think of price stability as an asset that just delivers large benefits to society over a long period of time. We really saw that for a long time. The United States had 2% inflation, didn't move around much, and that was enormously beneficial to the public that we serve. And we have to get back to that and keep it for another long period of time. To pull back from the task of doing that is you're just postponing. The record shows that if you postpone that, the delay is only likely to lead to more pain. So I think we're moving to do what we need to do and do our jobs, and that's what you see us doing.
Thank you for taking the question, Mr. Chairman. Edward Lawrence for Fox Business. So you had said that Americans and businesses need to feel some economic pain as we go forward. How long from here should Americans be prepared for that economic pain?
If we get to
how long?
Around
it really depends on how long it takes for wages
111.07,
and more than that prices to come
that's
down
a good
for
long
inflation
on the equity
to come
markets.
down. And what you see in our in our projections today is that inflation moves down, significantly over the course of next year, and then more the next year after that. And I think once you're on that path, that's a good thing, and things will start to feel better to people. They'll feel lower inflation. They'll feel that the economy's improving, and also if our projections are close to right, you will see that that the costs in unemployment they're meaningful, and they're certainly very meaningful to the people who lose their jobs, and we talk about that in our meetings quite a lot. But at the same time, we'd be setting the economy up for another long
so
period.
So we will have probably
this era has been noted for
40
very long
minutes to
expansions.
trade.
We've had 3
Let's
of the 4 longest
goes.
in measured history.
I won't be rushing
since
to
we
any
got
trade.
Inflation under control, and that's not an accident.
I will
so
try
when inflation
to
is
get
low
a
and
good
stable,
setup.
You can have these 9, 10, 11.
Take advantage of the
10-year,
volatility.
anyway,
If not, tomorrow we will have volatility.
Expansions, and you can see what we saw in 2018, 19, and 20, which was very low unemployment, the biggest wage gains going to people at the low end of the spectrum, the smallest racial gaps that we've seen in since we started keeping track of that. So we want to get back to that, but to get there, we're going to have to get supply and demand back in alignment, and that's going to take tight monetary policy for a period of time.
As a follow-up, what is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises. And so we want to avoid that.
I mean, what the dollar does in every meeting, the last 4 meetings has done actually is it drops, but not this meeting. The dollar is still rising today.
Existing home sales have fallen for 7 months straight.
It was
mortgage rates are at their highest level since
almost
2008.
1% or
yet mortgage demand
1%.
increased this week, and housing prices are still elevated. Now, at the end of your June press conference, you mentioned plans to reset the housing market. I was wondering if you could elaborate on what you mean.
I do think the dollar will continue to rise.
What you think it will take to actually get there.
So when I say reset, I'm not looking at a particular specific,
right now is
data
going back
what I'm really
up.
saying
So
is
if
that
we have
had
a
time of
111.07
a red hot housing market
and
all over the
NQ
country,
is in
where,
a high quality
famously
demand,
houses were
I will
selling to
take that.
the first buyer
But
at 10%
not
above the
while
ask before
Powell
even
is
seeing the house,
talking.
that kind of thing. So
if he is on the press
there was
conference,
a
I
big
won't
imbalance between supply and
trade.
demand. Housing prices were going up at
When
an
he's out,
unsustainable
I
fast
will
level. So
put my charts
the
up
deceleration
and
in
we
housing prices that we're seeing
can
should
look
help
up for
bring
trades.
sort of prices more closely in line with rents and other housing market fundamentals. And that's a good thing. For the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level, at a reasonable pace, and that people can afford houses again. And I think we probably in the housing market have to go through a correction to get back to that place.
There you go.
There's also
for those who want to buy houses,
though, with the housing market, as you know, we're it's difficult to
certainly
find
decline
lots now close
I
enough to cities and
mean,
things like that. So builders are
who
having a
am
hard
I
time
to
getting
know
zoning
that?
and
Nobody
lots and
knows that. I
workers
think
and
we're
materials and
going to
things
go
like that.
down.
But from a
but
sort of business cycle
that's my
standpoint,
opinion.
This difficult.
I don't have a
correction
crystal
should
ball.
put
I
the
do
housing
trade
market
my
back
trades,
into
and
better balance.
that's what I do.
Shelter made up such a large part of this hot CPI report that we saw. Do you think that there is a lag and that we will see that come down in the coming months, or do you think that there's still this imbalance that needs to be addressed?
Rents are going up.
I think that shelter inflation is going to remain high for some time.
There you go.
We're looking for it to come down, but it's not exactly clear when that will happen.
So don't worry. All good.
It may take some time. So I think hope
it's
for
hard
the best,
to
plan
predict,
for the worst. So I think on shelter inflation,
it's very hard to know what's going to
happen.
happen.
We'll go to Jean for the last question.
So this is the last
Jean
question.
Young with Market News. You've talked about the need to get real rates into positive territory, and you said earlier that policy is just moving into that territory now. So I'm curious, how restrictive is rates at 4.6%?
So we can trade together every day here.
Is
Welcome.
that expected to be next year? How restrictive?
Sure. So I think if you look, when we get to, let's assume we do get to that level, which I think is likely, what you're going to do is you're going to adjust that for some forward-looking measure of inflation, and that could be, you pick your measure. It could be, there are all kinds of different things you can pick and you get. But what you'll get is a positive number. In all cases, you will get forward inflation expectations in the short term, I think, that are going to be, assuming that we're doing our jobs appropriately, that will be significant. So you'll have a positive
we went to, right? Yeah, we went to
at that point
111.09.
1% or so. But I mean, I don't know exactly what it would be.
Let's see if it's going to turn around from there
when we get to that level. And let me say, we've written down what we think is a
there we go. The equity markets are turning.
The path that we actually execute will be enough.
NQ is
it will be
turning
enough to
from
restore
there.
Price stability. So this is something that, as you can see, they've moved
Let's
up.
see if we have a sustained drop on the dollar.
Watch incoming data and the evolving outlook, and ask ourselves whether our policy is in the right place as we go. Thank you very much.
All right, he's gone. All right, cool. So now that he's gone, we can pull up. All right, let's pull up my charts. I'm gonna open TradeStation. I can have it on all the time. My computer gets too slow. That also prevents me from taking stupid trades because I don't have the internals here. All right, so we can transfer to this screen. All right. So yeah, the dollar started to roll over, and the equity markets are responding to the upside. So right now, let's try to do our job here and make money trading. 500 share bars. There we go. Let me get rid of these. All right, I'm gonna put myself in this side. Cool. Huh. Give me 1 second, guys. All right, so let's see if we can have... all right, so I did have this area that I worked here, but didn't work anymore. All right. All right, let's analyze the internal. So the ADQD, is not ADQD is not bullish. I'll tell you this. ADQD is not very bullish. Tick chart created a low here. When is this low? 312. So 312 is right here. What am I? Okay. So this is my main screen. I can get rid of this. I can get rid of this headset. All right. Let's put my trader suit here. All right, I wanna look for something. Really. What time is this? 2:46, 2:46, 2:46. So 2:46 is the high. So so it coincides with this high on the tick chart. So I don't have any divergence as of now. I have no divergence here. Okay. Let me scrunch this chart a little bit. All right, I do have a resistance point right here, 12,070, and I have 0.93. Let's go take a look at the dollar. All right, that might be it for the dollar, right? MB, I know you're taking a look for the dollar short. I do think that might be it for the dollar. Yes, we retraced from 07. But we're hitting some pivot there just created. So be careful with the dollar right there. Don't lose it. Okay. Just keep it on your side. So if the dollar turns around, meaning it turns around for a continuation of today's upside, if it keeps going up, then we can try a short. Now, I don't have any divergence here. I certainly don't have any information from the ADQD. It's very sideways, and the market is pretty flat. It's just green for a little bit. Okay, so we might have some more downside here on the market. The dollar is not going down. All right, I'm gonna look for a divergence right here. So I marked out a couple of areas right here. So this one was a good area to trade from. Let me get rid of this. Okay, so you have one, two, 3, and then a rejection here. That's a good area to trade from. It's tested already. So this one certainly didn't work. So I do have 57 again. 57 was violated, so I'm gonna get rid of this. This is from 2 days ago. Ooh. Wow. All right. We do have this like W pattern or triple bottom, however you want to call it. 1, 2, 3. There we go. It worked again. I don't think it's going to continue to work, but I will pay attention to this. Now, the tick chart, what will be a good long setup right here is this. Come down here. But I will have to see the dollar above 1138. 1138. I don't think it's very likely that the dollar is going to move so high in 40 minutes for the remaining of the trading session. So I don't think this long will be. So if this long happens, let's say we have this and the risk will be something like this. And then we will have this. So this one, not the first one, but the second one. If prices come down ultimately to this area, $312 exactly. So if this thing comes to here and the tick chart is giving me the signal, not a lower reading, I'll take this one long. What are you guys thinking? I used to trade these markets with the news, but I learned the hard way. I don't think it's worth it to risk your money if one guy is talking and moving the markets. A lot of orders come in and come out. Yeah, you can make tons of money, but how much is your risk? That is the question that you need to ask yourself. And trading, like I trade, risking, let's say I lower my risk and I want to risk 30 points in NQ. All right, the swing was 350 points from the lows to the high. So I don't think it's worth for me risk one trade when the movement are so big. I do have a system which is profitable. I don't need to just take trades while this thing is all messed up. All right, so finally the dollar is back at 09. So this was the long. This was the long when the dollar came down. Now is back at 11.10, but tick chart is making new lows right here. This is not a bad area to trade from. Let's see if I can have this thing confirmation, and it's going to be very low risk though. It's going to be fairly low risk. $100. And where to? I don't want to go farther than this. It looks very scary, but the tick chart did not make a new low. Actually, it was the same low. So yeah, this might be a good trade right here. Let's see if we can have it. Let's see if we can have it. I'm just risking $100, just because the ADQD is not in my favor. I want to see this coming down though. It's holding right there. No, I mean, I do have this area, which is good. I want to see prices coming deep into the zone, and then I'll take it coming out of it. Tick chart is not terrible though. All right, so this trade, even though we're violating the zone, tick chart hasn't gone down though. So this one didn't work. I didn't take it. Tick chart was on the lows, but I think tick chart is not terrible. So we might have this one. See how this goes. 7 minutes has 4 more minutes to go, and we have a fairly new 3 minute. So if I take this one, right, coming out of it, how much is my risk and reward ratio? Oh my god. It's just one contract and 2-to-1. Yeah, this thing is collapsing. Let's go see the dollar. Yeah, it keeps going up. If we could have 111 38 or 30, I would say 34 to 38, that would be awesome for our long. Now, we did have very bad news off of the press conference and the summary of economic projection. So I think the momentum is more to the downside. Yes. Yeah. Look, the XY, I mean, this dollar index is very hard to trade. It is very hard. I have traded Forex. I still with a group that trade Forex off of Boynton Beach. It's called Gapad. So I used to trade Forex. And certainly the dollar is one of the most difficult assets to trade. I mean the dollar index. All right, so we have these. So what if we risk this? 1488. Oh. Yeah, it has to be one contract. So there you go. That was the area. Double bottom on ES. Yeah. I said no. Look, NQ the same. NQ the same. Here's the deal. If tick chart does not get lower than this pivot, which is well, minus 1000 is very overextended though. I think this long can't work. Let's wait for the dollar. All right, I don't want to get too cocky here. I just want to see in reality what is going on here. So the dollar continues. All right, so if we break this low, I will activate the order right here. Let's break this low and I will activate the order right here. What time is it? It's 36, so we have like 20 minutes for this trade to work. All right, so we are at the low. I do have an order right there. It's fairly low risk. I just cut my risk in half just because of the news and everything. Dollar, if the dollar starts to pull back from there, is from the middle of nowhere. So I just want to acknowledge that if we go up with the dollar going up, that's a good thing, because the dollar is gonna stop eventually at 111.34. Well, that is my next stop. If we break to the downside here, then we never got filled. All right, so let me report. If you guys can refresh your browser. Report. We got spammed somehow. All right, so we're making new lows, but the tick chart is not making new lows. So if we get to 345, I will cut the video. I will just wrap up this video because I don't. If you guys notice at 350, there's always a spike in volume, right? So I don't like to take trades right after 345. If I'm in a trade, then I have nothing else to do. But all right, so this trade never got filled. I think it's for the good. So let's just cancel this thing. So the dollar is keeps rising. Dollar keeps rising. That's why I like to wait to 1134. 1134. All right, so this area was violated. Let's get rid of it. We never got into anything. I didn't take any trade today. It makes sense. What do you mean, the 350? Go, just watch the chart very closely at 350 in the afternoon. As a matter of fact, we can stay here for 9 more minutes. And you guys see the spike in volume, and it goes all over the chart. So if we don't take any trade before 45, I won't take in any. I mean, in the morning was very choppy. Then during the news, is very low probability to take a trade, right? Unless you have unlimited risk, which I don't have. Let's say you want to open a position and keep it, then, well, that could be. But for day trading, if you have like 30 points, 40 points risk, The movement was actually 350 points from the lows to the highs. Yeah. That's why we cannot say we will go one direction. I've gotten it so wrong. I have gotten it so wrong in the past. Like, oh, we're going 1% and we're going up to 2%. But I've learned the hard way though. Where are you from, MB? I mean, where are you at? Indiana, nice. I'm located in Miami, but originally I'm from Venezuela. I've been in Miami for 8 years now. My English is so bad. I'm trying to improve it though. I really think that I need to, well, at least for the channel. But I do like a big effort to try to speak best way I can. Need to practice more though. All right, so finally 345. $345. That's a nice drop. We will have good setups tomorrow, hopefully. So NQ is dropping 1.5%. RTY is 1.25%. The ES is 1.4%, and the Dow is 1.4%. So, is very, very good. We will have some opportunities tomorrow. The VIX is back at 28. So, like such a swing on the VIX from 30, went back down to 25.50, and then it's going back to 28, like 20% swing. All right, DXY is approaching to 25, 111.25. Very red. Yeah. Wow. Daily chart is not good. Daily chart is scary. I hope these lows hold though. All right, so let's wait for the 350 candle, and then I'll close the live stream. But I just want to show you the spike in volume and volatility right at that time. I have my own theory, right? Because you can't know exactly what happens, but I think some algos try to balance at that time before closing, and that might cause some spikes. I don't know why at that time, but it happens every day. No, NQ, but I'll put it here so you can see it. What you will notice is just a volatility spike. That's going to be in 2 minutes. This thing is just selling. Sell, sell, sell. So we had one setup long in the morning. That's the one that I'm going to. So long setup in the morning. That was 9/21. Missed. So if you have seen on Saturdays, I'm doing this live stream where I backtest and review my trades. I'm gonna take that one. I'm gonna take that trade for this Saturday, so you can watch it and learn from it. If we happen to miss any other trade, but yesterday I think I already reviewed it. Today I didn't miss any trade. I had 2 long setups. I never had a short setup today in the afternoon. Like Powell was speaking and the thing started to drop, so I couldn't. I didn't have the intention to trade while Powell was in the podium. All right, 30 seconds. I'm gonna open up this chart a little bit, like so you can actually see what happens. 5 seconds. So we didn't have much reaction though. We didn't have much reaction. I don't know if this is typical. I've noticed this numerous times. Well, that's okay. Nothing happened. I'm gonna close I'm gonna wrap up the live stream. Please, if you like what I do here, consider to subscribe and share so we can grow the channel. See you guys tomorrow, okay? 8:45 for the pre-market and 9:25 for the live trading session. George, thank you, buddy. Thanks for being here. All right, see you guys tomorrow.